Good morning from partly cloudy and warm, humid Chicago, where I just returned not too long ago from watching one of my grandkids' soccer games. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today is Sunday, May 31st, 2026. Since I was with you last, which was exactly 2 weeks ago on May the 17th, the U.S. stock market has continued higher, driven by 5 primary themes, with one clearly dominating the others. The most dominant one has been renewed enthusiasm for artificial intelligence or AI spending, especially in semiconductors, memory chips, data centers, AI servers, cybersecurity, and cloud infrastructure. You can even see this when you look at international markets. The 2 big outperformers for the past several months have been Taiwan and South Korea. The others are strong corporate earnings, resilient economic growth, rising inflation expectations, and reflation trades, as the market has increasingly priced in higher break-even inflation rates, higher oil prices, and sticky inflation. And the final one is reduced fear around geopolitical and policy risks, as the market seems to think that the U.S.-Iran conflict will not severely disrupt global growth. You can see this reduced fear in low volatility according to the VIX. Let's take a look at that. So the VIX is the CBOE Market Volatility Index. This is the VIX daily going back to the latter part of last year. And the takeaway here is the VIX really started to move lower right here, which is April the 8th. And if we turn that around and we go to an S&P 500 chart, this is April the 8th. So the market got a little bit more fearless, a little more relaxed, and the stock market kind of took a sigh of relief and moved higher. The other place that you can see this lack of fear in the market is historically narrow corporate bond spreads. We're going to look at that chart right here. This particular chart is part of one of our reports that we put out earlier today. It's called the weekly wrap up. So there's that chart. So it's the ICE Bank of America or B of A AAA U.S. corporate bond index option adjusted spread. It's like a sentence for the name of this thing, but it calculates the average yield between AAA U.S. corporate bonds and comparable U.S. Treasury securities after adjusting for any embedded bond options. So basically what it's doing is it's measuring risk according to the bond market. And you can see when the spread is at near record lows, which it is now, if you look all the way to the right here, I'm circling with the mouse. When the spread is at near record lows, as it is now, it indicates that investors are perceiving very little default risk. Credit markets are healthy, liquidity is abundant, risk appetite is strong, and economic conditions are being viewed favorably. So even though the U.S. broad market has risen by a whopping 20.3% since March the 30th, which is exactly 2 months ago, and is now 11% above its 200-day moving average, the market is feeling comfortable. You could see that in the Asbury 6, which we're just going to look at in just a few minutes. But once you start getting 11% over the 200-day moving average, historically, you're usually at or near some kind of a peak. So we're not going on vacation for the summer and crossing our fingers. We're really watching the markets like a hawk, because this fearless condition can change very, very quickly. And I think even though the market's just been cruise control here for a few months, I feel we really need to stay on our toes, and that's what we're doing here. Like I said, we're going to take a look at the Asbury 6 and some other indicators that we have developed over the years. Before we do, let me tell you a little bit about us. Asbury Research is a registered investment advisor. We've been providing investment research to individual investors and professional money managers since 2005. So we've been doing this for 21 years. I've been doing it personally for, I think this is my 43rd year in the business. Asbury emphasizes what we call intelligent diversification, which is actively managed approach to markets that is designed to adapt to changing market conditions rather than relying on the traditional static set it and forget it that some of you may be familiar with by working with an advisor. For self-directed advisors, Asbury offers both its flagship Asbury Premium research service and also a lower cost Substack newsletter, which I'm just going to jump to for just a second. Here we go. So this is asburyresearch.substack.com. It's $25 a month. It's a stripped down version of the premium service, but there's a lot of information here, and we'll go through this if I have enough time at the end. We'll just kind of go through this quickly and show you what some of the components are in our Substack offering. For investors who prefer a managed account, Asbury offers 4 proprietary model portfolios that are built with our own models, such as the CPM or the correction protection model or the CEF model. If you've been following us, you're probably familiar with those 2 models. They're designed to achieve competitive market returns while also drastically reducing overall portfolio risk. That's kind of our focus here, and what we're really good at is giving you the market with a lot less risk in terms of standard deviation, in terms of Sharpe ratios, in terms of betas, and in terms of maximum drawdown. These model portfolios have undergone extensive backtesting for 8 years, looking backwards, and they've been trading in real time for a couple of years. Here's a graphic here. So this is our 4 model portfolios year to date. So our Asbury Aggressive has outperformed the S&P 500. This is year to date by 6.6% with approximately a 50% lower maximum drawdown and a significantly lower standard deviation. Our Asbury Balanced, which is second from the bottom here, has outperformed the S&P by 1.6% so far this year with about a 60% lower maximum drawdown and, again, a lower standard deviation. Lower standard deviation means that your P&L is going to be less volatile than the S&P 500. That's effectively, in layman's terms, what that is. Our Asbury Conservative model has outperformed the S&P by only about 0.5%, as we can see here. But the drawdown has been minuscule. I don't have it in front of me, but this is for people who want to be in the market but can't stand all the drama, can't stand the drawdowns. So full disclosure, all of my own money that is in the stock market is all in my own models. So we're eating our own cooking here because, frankly, I'm an older investor and I don't want to wake up every morning and have my blood pressure jump up, to drastic altitudes when I turn on TV and I see what's going on in the S&P 500. So again, we're basically focused on trying to get market returns with a lot less risk. So now let's get started to why we're here. And let's go back to the website and let's have a look at the Asbury 6. So we're going to go back here. We're going to go to the Research Center. This is the paywall, the Research Center, and the Asbury 6 is right here. So the Asbury 6 is meant to be an indicator rather than a model. I actually built it and used it internally for years, a earlier version of it, because it was getting difficult for me after doing this all my life to keep track of what was going on in the market. It was up 100 today, it was down 70 tomorrow, down 30 the next day, and I was getting scared out of some really good ideas because of all the volatility. So rather than chase the tail of the S&P 500, we follow these 6 metrics. And we have our own spin on these. but they're basically the rate of change in the S&P 500, the relative performance of stocks versus high-yield bonds, investor asset flows, volatility, trading volume, and market breadth. It allows us to kind of keep our eye on the ball. 4 or more of these, green, means that the model itself is positive. It's been positive now since April the 6th, from going negative prior to that on March the 6th, and the S&P since April 6th has risen by 14.6%. It's active. Its trades are about 9 round turns a year. So positive to negative would be 1 round turn, about 9 a year. And again, it's part of one of our premium. It's one component of our premium research subscription. Let's go back here and look at why drawdowns are so important to us. This is just a simple chart that shows when you have a drawdown, what has to happen for you to get back to where you were at the top. So let's say your stock, it runs up to 9, it drops to 6, and then on its way up to 9, back to where you started at the peak. Here's what happens. Let's use this for an example, because the S&P drew down by 34% in 2020. That was during COVID. Actually drew down 34%. So here's a pretty close example. If the S&P draws down, the maximum drawdown goes down 30%, you need to make 43% on the way back. And when you're 35, my son and my partner, Jack, he's in a whole different ballgame. He wants the market to go down so he can dollar cost average and he could buy stocks cheaper. So when he gets to my age, he's got a better average. Once you get to my age, I'm in my late 60s, the game changes, and it's very much like football. I always use this metaphor because I think it's spot on. In the first half, which is a 35 or a 40-year-old investor, you can take some chances, you can take some shots because you've got the rest of the game in front of you. Once you're in the fourth quarter, like I am in my investment life, and I've got a lead, I don't want to give it back. So I'm really paying big attention to trying to avoid drawdowns. Everyone is used to the fast drawdowns where you have a quick 30% move down and then we're making new highs in 6 months. That is not always the case. And if you're older and you've had a third of all of your money in terms of drawdown, what if you don't get that money back for 4 or 5 years? It's totally possible. It has happened before. So this is why we stress so much on talking about drawdowns. Let's get back to markets and look at our CEF model. Our CEF model is our sector rotation model. So we'll get back up to the research center and we will roll down to CEF. And so what is the CEF model? Let's get right to the graphic here. I'll blow it up a little bit so we can see it better. The CEF model, one of our older models, this one's probably been around for 7 or 8 years. It's a completely data-driven sector rotation model created to quantitatively identify long overweight opportunities in U.S. market sectors by following the money around the 11 sector spiders, which you see right here. Which, if you put those 11 together, it's the S&P 500. It's always fully invested in the market. Whether the market is up, down, or sideways, it's always fully invested. We're always investing in the top 3. So this week, we are invested in XLK technology. You can see it's got ones all the way across 3 different time frames: trading, tactical, and strategic. This means that the fastest money going into any one of the 11 sector spiders in 3 different time frames was all in technology. Here's consumer discretionary here. XLY is the second, and we got 2s all the way across, 2, 2, 2. So we've got a 6 here in terms of the composite score. So 3 and 6, because tech was 1s all the way across the board, consumer discretionary is 2. People are avoiding utilities and financials and energy right now. This is why they're all at the bottom. So since April the 6th, technology has been one of our top 3, which means that was one of the 3 sectors that we invested in. Since 4/6, XLK has risen by 39.7% outright, while outperforming the S&P by 21.7%. This is why we do this. When the market is normal, the 11 sectors kind of go around together, go around the track together, to use a horse racing analogy. But when one or two horses break out, this is where SEAF has some really good years. In 2022, the S&P was down 18.7%. SEAF was up 8.3 because we caught energy in the early part of that year and we rode it from January to June. So this is basically how this works. And again, right now, tech, consumer discretionary, and materials are where the money is going. The money is coming from utilities, financials, and energy. The next thing we're going to do, we're going to look at another one of our premium research components. There's a number of components. We've got a CPM is a correction protection model, CPM. We have ETF trade ideas. We have a lot of models here. Let's go down to keys to this week. And keys to this week is just what it sounds like it is. We probably look at 100 and 150 charts, and we pick out 10 that we think are the most important. They're likely to be the most influential to future market direction. So there's a couple here that I think you'll be interested in that we're going to talk about today. Here's number 2 of 10. This is the Dow. This is going back to the latter part of 2021. And everybody has been talking about 50,000 in the Dow, including Pam Bondi, for some time. It's been trying to get through it since February. It looks like it's finally getting through. Why is that important? Even though the S&P is really the benchmark right now, a lot of people still look at the Dow as being kind of a bellwether for the stock market. I think more lay people, pay more attention to the Dow, even though we don't. But 50,000 is a big number. The market obviously thinks it's important. It's been trying to break through it since February. It came down to its 52-week moving average at the end of March, and now we're starting to make fresh highs. I think this is important as long as we can stay above 50,000. It's an indication that that risk appetite that I talked about earlier is still intact. Let's move on and look at, this is MAGS. MAGS is the ticker for an ETF that tracks the Magnificent Seven stocks, starting to break out to fresh highs here as of the 8th of May. Struggling a little bit, but holding its own. Here's the relative performance of MAGS versus SPY, which of course is the S&P 500 ETF. And it got up above its 21-day moving average on April the 10th, which means on April 10th, MAG started outperforming the S&P again on a monthly basis. And look what happened to the trend. And this was what the trend in the S&P 500 looks like also. We had a bottom in March, and now we're moving higher. So we're paying a lot of attention to relative performance. Semiconductors have been leading for months. They still are, but they often need a little bit of help. That help right now is coming from the Mag 7, a lot of these AI stocks. So we're really paying attention to relative performance in terms of the Mag 7. The next one is chart 6. And this is a real simple seasonality chart. This seasonality chart isn't annually, it's quarterly. So this is the weekly seasonal pattern for the second quarter. There's 13 weeks in a quarter, right? So we have 13 columns here, and this shows us what to expect through the end of the second quarter, specifically June. So in June, so the third week of April is the strongest week of the entire second quarter. And then we gradually weaken seasonally until June. June includes 3 of the 4 weakest weeks of the entire quarter. So I'm not a person that's going to put a trade on because of seasonality, but I do pay attention to it. It's kind of like the wind. If the market's going up, weak seasonals may put a little bit of a damper on how fast it goes up. And if the market's going down, it could actually accelerate the decline. So it's kind of a tertiary indicator for me, but we do have a very weak June coming up, and I think it's worth paying attention to. Finally, let's see, we've got chart 7 here. This is, here we go. This is the last one that I wanted to talk about here. It has to do with interest rates. Right now, TYX is the CBOE 30-year Treasury bond index. You can see it's testing 51.22 to 50.66. So this is basically a 507 to a 512 yield in a 30-year bond. We poked our head up above it for a minute here on May the 19th, and now we're moving back down. This is an important day to day, but if we start trading at fresh highs here, these highs go all the way back to July of 2009. So you're talking about a 15, 16, 17-year high here. So watch that 507 to 512 area in the 30-year if we start to exceed it. If inflation starts to pick up and long rates start to move on that, this could be a really important chart for the back half of the year. Last thing we're going to do is we're going to take a look at our Substack. And here it is. I told you we would mention if we have time. I'll go through this quickly. Again, this is an entry-level $25 a month service. There's also a free version. So if you like what we're doing, if you're watching our videos and you haven't subscribed to the free version yet, it's kind of a no-brainer. Sign up and you'll get to learn more about what we think is important about the markets. So there's three pieces to this. The first one is chart focus, which looks a lot like the keys to this week that we just looked at. A lot of charts, basically telling you what we think is pushing markets around right now and what to pay attention to. Our next one is our sort report. And what sort is sort is a quantitatively driven sifter. It's kind of a sifter. So we look at a lot of different types of assets, very broad, comprehensive. U.S. technology, global equities ex-U.S., emerging markets, small cap, U.S. dollar, commodities, crude oil, gold, U.S. interest rates, and crypto. And we look at them in terms of trend, relative performance, and also money flows. Is there money flowing into these ETFs or is there money coming out of them? When all three are green, this tells you these are places to look for opportunity, especially in a market like this that's very narrow. Right now, the ones that are checking all the boxes rather, are U.S. technology, global equities ex-U.S., emerging markets, and small cap. So this is a very quick, I think this is updated in this particular $25 service twice a week, but this will tell you where to look for opportunities. And our last one has to do with our CEF model. This is the rainbow chart report. It's new. It's only been out for a few weeks, but what this does is looks at our CEF and indicates where the money's going. This is healthcare. So we mentioned healthcare has been one of the weakest for some time. Once healthcare moved into a void on April the 2nd, according to the CEF model, you can see that XLV has underperformed SPY by 12%. So knowing these trends and asset flows could really help you to get in front of some really good trends that are really driven by the money that is moving around the sector spiders. So that's it for today. Our next Following the Money podcast is tentatively scheduled for Sunday, June the 14th. That's exactly 2 weeks from now. Hope to see you then. In the meantime, if you have any questions about what we're doing here, or want any information about a research subscription, or want to look at our managed portfolios further, we could show you some details on those. You can contact right here via the contact tab if you're interested in research. And if you're interested in a potential managed account, this is where you go, the tab that's right next to it. Enjoy the beginning of the new baseball season. My Chicago White Sox, I'm still trying to figure out how to pronounce his name. It's Munetaka Murakami. He's a new player from Japan. He's tied for second in MLB with 20 home runs, trailing by 2, but very exciting season for us. Anyways, I'm going to go watch a baseball game. See you in 2 weeks, and don't forget to like and subscribe.